Hey, it's Chris with Life 180, and for this video, I want to talk to you about how you can save your money like the Federal Reserve saves its money. And this, I think you're going to find this video fascinating. Now, I'm going to tell you right now, there's some amazing books. I'm excited, actually, as I film this video. I'm kind of prepping for a conversation tomorrow that I have with Dyke. I'm not sure when that interview is going to go live. I'm going to try to make it as quick as possible. This book completely changed my life back in 2009 when I joined the industry. Dyke, The Pirates of Manhattan, phenomenal book. And then later in 2011, he launched this book called Pirates of Manhattan, Highway to Serfdom. It's an amazing book, and it goes through, this guy's like the best researcher in the entire industry. There's a new documentary coming out later this year. I think it'll be later this year, called The Boomer Dilemma, all about the retirement income crisis for baby boomers. And also in 2015, he launched this guaranteed income book. And now, in this book, I'm like right now, I would suggest everybody go to Barry's website and get this book. It's amazing. It's on page 54 and 55 I'm on right now. I was just looking at this stuff and I was like, wow, you know, I got to do a video on this and talk about it because it's phenomenal. It really, it's crazy to me. So when I talk about saving your money like the Federal Reserve saves their money, there's a couple excerpts in here that I want to bring up, that I want to talk about and kind of let everybody I guess, take a look under the hood. And everybody knows I'm a big believer in whole life insurance being a tier 1 foundational asset in everybody's life. I believe that right now we're coming up into a serious retirement income crisis for baby boomers, for anybody that's looking to retire. As everybody, I don't know if you thought about this or not, but everybody faces different risks when it comes to their income in retirement, right? The things that we have to consider in retirement are longevity risk, like how long are we going to live, and is the money that we have for retirement going to last us forever? Remember, it doesn't matter how much money we have when we retire. It only matters the standard of living that our money is able to provide us, right? And if we live too long, obviously that puts our money at risk because it exposes us to more market risk, which is another risk that we have. I guess everybody always has market risks, but one of the challenges is there's a thing called sequence of return risk, meaning when we have down markets, which quite frankly are inevitable, when those down markets happen are really important. So for instance, if I retire at 65 this year and then 2 years from now, there's a 30 or 40% correction in the market and my $1 million turns into 400 or 600,000, that's going to have a huge negative impact on the longevity risk that I bring to the table, because now I have to have that 600,000. I don't have the ability to just let it sit there. For the most part, most people don't have the ability to just let it sit there and build back up. You have to liquidate a negatively performing asset. So now, if you were able to take, let's just say 5% off of the $1 million for your income, that's a $50,000 a year income. But if you still need that $50,000 off of $600,000, that's a much higher percentage. That's almost 10%. It's like 8.6%, I think, or something of that nature. And so if you're taking 8.6% off instead of 5%, that eats into the principal and it puts your account at much more risk. And one really bad year early in your retirement sequence can put you at risk. And so the idea is the people who run this country, run this world financially, because the world's reserve currency is the US dollar and the Federal Reserve ultimately runs the US dollar. Ultimately, they print the money. They basically run the monetary policy effectively. I want to go back. Everybody knows who Ben Bernanke is. Everybody knows who Janet Yellen is. And so I want to read a couple highlights. So I'm gonna try to get into this a little bit and read this. So former Federal Reserve Chairman Ben Bernanke plays it safe with annuities. Should you? This is the title of this. So most of Ben Bernanke's $2.3 million portfolio, or about 90% of it, was invested in fixed or variable annuities. So remember, annuities guarantee income, right? About 6% was parked in cash, while equity and bond mutual funds were about 1% and 2% respectively of his portfolio. So it's crazy to me. You have who was once the chairman of the Federal Reserve, and everybody's out there, in the Federal Reserve telling people to take market risk, here's how you invest. But the guy who's running the whole monetary policy for our country, 90% of his money is in annuities. Why? Because he's older. So this isn't necessarily good for young people, but if you're 54 or older, annuities have to be a part of your retirement plan. They have to be. Like, there's no way to optimize it. I'm going to take it the next step further. Federal Reserve Chairman Janet Yellen, who is the next Federal Reserve Chairman, and she's now the Secretary of the Treasury at this point in time, but at the time of writing this book in 2015, she was the Federal Reserve Chairwoman. Pension annuities are the largest family asset. So the largest family asset of new Fed chairman is not the couple's bonds or equity funds. There was a whole paragraph of their bonds and equity funds, but the generous pension annuities they receive from the University of California Retirement Plan. According to the Schedule A filed to the U.S. Department of Ethics in 2013, Yellen and her husband, whose total compensation was $572,578 in 2010, can count on more than $25,000 a month in pension annuity benefits from the UCRP and an additional pension annuity benefit from the Federal Reserve Bank of San Francisco, an amount estimated to be about $4,166 a month. So if one was to purchase the pension annuities that Yellen and Ackloff, her husband, own in a single premium from a life insurance company, which one could do, they would cost at least $4 million. And that was back in 2015. Rates on annuities have gotten more expensive now, so I would venture to say that the $4 million it would have cost in 2015 at the writing of this book would probably be upwards, north of $4 million at this point in time. So this just goes to show, we've got Bernanke and Janet Yellen who are out there coaching everybody in the world to take risks, coaching everybody that they got the markets under control, that inflation is transitory, that, you know, money printing isn't a problem, that all these things going on in the government are not, you know, putting you at risk and the markets are fine. Yet in 2008, when all these banks failed, Ben Bernanke had all his money in annuities. He didn't lose a dime. He didn't get hurt at all. And his advice was keeping people in the markets, which to me is just a scam. So now the Federal Reserve 401k, this is where it gets really fun. The Federal Reserve's 401k thrift and savings plan. Fixed annuities are the biggest asset of the Federal Reserve's thrift and savings plan. So in 2008, the largest asset in the Federal Reserve's $4.2 billion 401k plan, which covers more than 18,000 participants, had more than 75% invested in its interest income fund. That fund, worth $3.2 billion, is almost exclusively invested in fixed annuities from major American life insurance companies. So while most 401ks in the world are touted that you should go mutual funds, you should put your money in these target date funds, and that's what Congress passed was, you know, this, I can't remember the name of the bill, but the bill that created target date funds that would make the risk tolerance change as people age, right, based on the target date of their retirement. Even though that's the case for everybody else for Main Street that's working at a blue collar job or even a white collar job, that's what people are doing. And at the end of the day, the Federal Reserve has 75% of their money in their 401k for their 18,000 employees sitting inside fixed annuities. Like, that is, it just goes to show you like how much of a disconnect there is between Main Street, Wall Street, banking, and that's why I'm so passionate right now. I'm so excited to be having this conversation with Barry. I don't know, you know, this video is definitely coming out before my conversation with Barry, the author of this book and the author of both the Pirates of Manhattan books. And he's going to be featured in the Boomer Dilemma, the movie that's coming out soon. So I'm really excited about that. So if you have any questions for that, I'm going to put this up. Make sure you're subscribed to this channel. Make sure you watch that video because I'm telling you, the guy is a genius when it comes to this. He's just been blessed with an amazing ability to do research and be able to find stuff. I mean, this book right here, I'm looking at it just to give you an idea. This book really is super simple. It's 70 pages of writing, and then it's 60 pages of just financial statements from companies, corporations, banks, showing all these major corporations, Fortune 50 companies, massive banks that are utilizing life insurance, whole life insurance, never IUL, whole life insurance and annuities as part of their pension plans and as part of their defined benefit plans and as part of their tier 1 asset for their institutions. So it's pretty funny that organizations like Comcast and Deloitte and Coca-Cola, and I'm just reading off the companies, Boeing, Bank of America, Castle, oh wait, that's Castle Asset Management. These are things he sent. AT&T, I'm gonna go through here a little bit and just ExxonMobil, General Electric. Let's keep going. I'm gonna find IBM. This is mind-blowing. And these are all public information. Lockheed Martin, McKesson, Pfizer. How about that? That's pretty cool. United Technologies. Oh, it's the same report. Wow, that's a lot. Deloitte. Yeah, so like you can see there's a ton of stuff. Like this book is just, it's phenomenal. I would suggest go to Barry's website, get this book, read it. It will make a difference in your life. If you're an advisor, I would totally, like this will educate you a ton. His first books changed the way that I looked at the industry. When I first joined the industry, I thought I was gonna be in insurance for a year, and my goal was to go join my father-in-law and take over his book of business. As soon as it was reading Barry's first book, The Pirates of Manhattan, that made me stay in the insurance industry because I realized how important our mission was. But we need to make sure we're doing business the right way. You need to understand these conversations. The biggest impact you can make as a life insurance agent is having a real high quality conversation with the people in your world that you can make a massive impact in their financial future, and helping people with the financial design, their financial structure, and their financial system that they operate inside of, and really educating people how money works is a huge component to it. Nothing is gonna help you have a better understanding than going through these books. There's no better books in the industry that will do it. So anyway, I hope that helps. I hope you found value. I hope you found this a little bit fun. It's a little different from what I normally do, but super excited to have Barry on the show. If you have any questions at all, comment in the comment section below. I will engage with every comment possible. Like this button, share this video, please. I appreciate all the help, love, and support that you guys are giving this channel. Close to 10,000 subscribers, really trying to get there. So if you have any agents, anybody you think would benefit from this, I would just be super grateful and blessed for you to give a share and try to share this channel with people to educate them on everything. And yeah, that's it. Hope you have a blessed, inspirational day, and I'll see you on the next video. Take care.